Hello, everybody, and welcome back. It is Thanksgiving week here in the U.S., and we've got Travis, aka the Stock Geek, and Nikki, certified financial planner, and yours truly. What's up, guys? How's it going?
What's up? How's everybody doing?
Good. Good. Ready to give thanks this week and eat turkey. Oh man, did you guys see that tweet that the St. Louis Fed put out about turkey costing more than soybeans and you should go for soybeans this Thanksgiving?
What?
Did nobody see that? Oh my God, pull up the St. Louis Fed Twitter. It was so funny. It was basically a tweet saying like, hey, instead of turkey, which is going to be more expensive, go with soybeans, a tofurkey.
I think I'll pay the $30 extra for the turkey or whatever it's going to cost.
It was hilarious.
That reminds me of like the IMF's new thing where they're like, you're going to own nothing and be totally happy. It's like, hey, just eat your soybeans, eat your crickets, save the planet, and you'll be good.
Nothing against soybeans. It was just a hilarious tweet for the Fed to put out.
Yeah,
I always wonder,
don't tell me what to eat.
I always wonder who's running these accounts because, when everyone sees a tweet from, a Federal Reserve Bank or something like that, they assume it's, some official with lots of experience, but it's probably just some college intern tweeting whatever they think is appropriate.
Yeah, it was just a chart of turkey prices versus soybean prices.
Here we go. I found it.
You found it. It's
yeah, a Thanksgiving dinner serving of poultry cost $1.42. A soybean-based dinner serving with the same amount of calories costs 66 cents and provides almost twice the protein. Yeah, I don't think I'm going to be eating much soybeans for Thanksgiving, but thanks anyway, Fed.
I just thought it was hilarious.
Yep. That's kind of like when they came out and said, hey, don't worry, there's not much inflation in food outside of steak, turkey, chicken, ham, basically any kind of meat or protein source. So there's really no inflation outside of that.
Yeah. Besides everything.
Anyway, guys, welcome to the show. We've got a lot to cover today, and thanks for being here with us. Again, also thanks to our sponsor, Y-Charts, who is an excellent source for data, both in stocks, crypto, economic stuff. Go check them out and tell them we sent you. And they'll give you a discount. And let's go ahead and just jump into some positive news. This week, we've seen El Salvador is planning Bitcoin City. And basically what they're doing is they're raising $1 billion. They're doing $1 billion bond offering to buy more crypto, and they're going to use half of that to buy crypto and then have to develop. And they've been really outspoken about using volcanic power for mining and things like that. So pretty interesting to see. It's kind of in the same, I guess, category of what Saylor's been doing with raising capital to buy Bitcoin. I mean, talk about having a lot of conviction and going all in. What do you guys make of that?
I mean, I'm just glad that, the president of El Salvador is normalizing wearing a backwards hat. I mean, if he can wear a backwards hat to an official government announcement, then, hey, I can wear this anywhere. So, solidarity.
Yeah,
right
man.
here.
The only thing is he doesn't have hair as good as yours.
He does look like a cool dude. I'd like to have dinner with him. That'd be fun.
All right. So moving on, I guess, on the crypto front, we're obviously going to talk about price and what's been happening. We had a little bit of a pullback the past couple of weeks. Something kind of fun that happened last week was the ConstitutionDAO tried to buy an early copy, I guess, of the Constitution for about $40 million, but they got outbid by the evil Ken Griffin. Did you guys see this? And if so, do you have any thoughts on it?
What an epic level troll by Ken Griffin. Ken Griffin is one of the founders of Citadel, of course, which is a hedge fund and also a market maker, and became the target. He's like the villain of the whole GameStop saga from earlier in the year. And so, a lot of people think that Citadel's manipulating markets and was holding the price of GME and AMC down, even though those stocks are up like 1,000% this year. But the fact that he was the one that outbid the ConstitutionDAO, to me, just is such a like epic level troll because, it almost is, maybe it's a spark that's going to unite like the Wall Street Bets crew with the crypto crew, and they'll have a common enemy. And, I don't know what his end game is. I don't know if he was planning to bid on this anyway, but it's all very 2021. I mean, how can this year get weirder in markets, right? So I think it's kind of hilarious. And also, it's also interesting though, from the ConstitutionDAO, I think is a really positive evolution of crypto, right? I think it shows the power of DAOs, which a lot of people have talked about, but I don't think there was a whole lot of widespread mass market understanding of what a DAO is or could be until now. And so I think that helped raise awareness of DAOs and what the potential power of these vehicles could be over time. So we're just on the front end. We're in inning like one of, decentralized autonomous organizations, DAOs. And I think there's going to be a lot of interesting ways those vehicles are used to, bid for assets or create organizations that don't have centralized power. And this is going to like potentially change the way that we structure certain types of organizations globally. So it's going to be interesting to watch over the next couple of decades how that plays out.
Yeah, I agree. And it feels kind of like we're at the opening pitch, right? And for so long, the only way to raise a lot of money and do big things and make big investments in either venture backed startups or whatever is through the general partner, limited partner, basically manager investor model. And to do that, at least in the US, usually you have to be an accredited investor, where I think these DAOs are going to open the doors for not only different types of creative fundraising and, doing fun stuff like trying to buy copies of the Constitution, but it also allows like people in really remote areas of the world to become part of really big projects, where before, if you're not in the Bay or New York or Austin or whatever, you're going to get left behind. So like you said, I mean, it opens up so many creative ways and so many options for people to participate in really big movements. So cool. All right. Well, let's go ahead and jump back into the charts and the news. Let's start by, what do you guys want to start by looking at? Actually, let's talk about Bitcoin and inflation and Bitcoin as an inflation hedge. Nikki actually helped me publish this article through Y Charts, where we just talked a little bit about, why Bitcoin is a better inflation hedge. And obviously with inflation at multi-year or multi-decade highs, a lot of people in the mainstream are starting to think of this. And obviously Bitcoin's prices reflected it. Over the past year, we're up about a double on the year, and even more so over the past couple of years. But if we take a look at the price action, one thing that I've been really interested in is how Bitcoin reacts when its price is at or near all-time highs. Typically you'll get like a trap. So you can see we had a couple actually of high ticks of new all-time highs, but historically Bitcoin doesn't just rip through new all-time highs. The only time it really did that was kind of the first big explosion in 2013. And every retest of a new all-time high after that has taken time, right? And there's a lot of volatility. There's a lot of traps. There's a lot of stop running that happens. And so I've been just kind of patient and waiting for a pullback. And you can see that, from late September, we had a strong run from about 39, 40K up to, 68K. And as of right now, we're pulling back in what I call the sweet spot retracement zone. And so with Bitcoin, a lot of other projects have been following suit. You can see Ethereum has also done that, and just been really kind of paying attention, looking at what cryptos are still either in accumulation ranges or haven't had big breakouts yet. And this is what we kind of call popcorn season, where you start to see different projects that start to decouple from Bitcoin. So you can see as of right now, Bitcoin's down, a couple points, but you'll start to see this popcorn season where, like today, Atom is up 13%, Curve, IOTA, right? Like, I really like to see this when certain projects just start to attract capital flow, even if Bitcoin is flat to down. That can be a good sign that there's still capital flowing into the ecosystem, even if the larger cap ones are maybe flat to down. So yeah, that's kind of the price action there. Just keeping an eye on that.
So is Bitcoin the new and improved inflation hedge?
What do you think? What's your spin on that?
I mean, I think that for the reasons pointed out in the article, I do think that, first of all, Gen Z and millennials are gearing more towards Bitcoin as a hedge versus gold. Gold is starting to finally see some momentum upwards as the latest inflation print happened. So it's reacting the proper way it's supposed to be reacting when, prior we were looking at gold thinking, why is gold not mooning, right now with inflation the way it is? So it's interesting to see how sometimes Bitcoin is showing as the hedge in its price action while gold lags, and then gold catches up. And, now gold and Bitcoin are kind of both reacting in a similar fashion. So I do think, though, that it is a new and improved hedge because the fact that younger generations are more likely to pick it over gold. I still think there's a place for gold, but also Bitcoin's more practical in terms of being able to use it. Gold, you gotta take it. You can't just break up gold. It's a big bar of gold or coin of gold, and physically it's difficult to transact with it. Bitcoin is more practical in terms of if you were in a situation you needed to use it, that's why it's easy to use. And with the gold, that's been an argument, right? Like, oh, I need my gold in case shit hits the fan and I have to, go get it out of my vault and barter with it or whatever. So that use case is still there for some people. But yeah, I do think that people are starting to see it as even maybe in the investment advising community, people are starting to see it as more so a better play because of the return potential and the usability and the return potential. Which is big.
Yeah, obviously the gains are awesome. But when you look at just the basic properties of money, like what is money, right? That's the name of the show. We talk money. We talk about what money is, how people view it, and the fact that it's really just a social construct and money is whatever we say it is. And people look at Bitcoin and go, oh, yeah, it's transferable. It's borderless. It's got all these properties that just make it the best form of money that humanity has ever known. Obviously, there's always going to be bear cases and haters, but when you just look at the fundamental facts of what it is, yeah, when the government starts creating dollars out of nothing and printing and, making the money printer go burr, Bitcoin just becomes more and more attractive. I don't know. Trav, what do you think?
Looking at, just purely at the data, you mentioned obviously the big difference in overall nominal returns, but the drivers and the correlations of gold and Bitcoin are very different. So, gold's very correlated to real rates, which have been, very weak over the past couple of years. And that's why gold hasn't been performing super well. Obviously, Bitcoin is not as correlated to real rates. It actually looks more correlated to like nominal rates or to, other asset classes. And so I actually think gold and Bitcoin can both play a hedge role, but in different types of environments. So I don't think it's time yet to totally write gold off as a portfolio hedge, but I do think Bitcoin is clearly providing some sort of like nominal inflation hedge, which is different than gold. And that is also valuable. So I think just given the overall return levels, just the overall like narrative behind Bitcoin, it's been a better overall asset to be in, for a variety of reasons. But, between gold and Bitcoin, they're correlated to different things, and they seem to have different fundamental drivers. So both potentially have a very important place in an overall balanced like portfolio.
I mean,
maybe
Chris,
in different
you
size
even
allocations.
Yeah, you even mentioned that sorry, there's a delay. I didn't mean to talk over you, Trav, but you mentioned in the article that you still have gold in the portfolio and you're still seeing it as a hedge.
Yeah, I mean, look, I have some gold. I accumulated some over the past several years when it was down, I think around the $1,200 range, but it's a very small percentage of my portfolio compared to Bitcoin. And what's funny is even Peter Schiff said that. He said that gold is a small percentage of his portfolio. So even the biggest gold bugs in the world don't really allocate a ton to it. I mean, I don't know why you would. The data doesn't really back it up, and just the usefulness of gold. Like, I guess if the internet shut down and people just went back to living in the Stone Age, maybe gold would be a better form of money. But look, we live in the digital age, and we are about to go into the metaverse, never to escape. And so who wants to have gold in a metaverse when you can have crypto? So that's my take. And that's why I'm heavily leaning into Bitcoin. And, look, a lot of Bitcoin maximalists, by the way, they say that everything that's not Bitcoin is a scam. I don't think that way. Like the way that I think about it is Bitcoin is hard money, and most altcoins are startups trying to do different things, right? So everybody lumps crypto in this one bucket, but they're very different things. And that's how I think about it. And that's why I don't really use any other coins as a store of value like you would with Bitcoin. It's more like a high risk, like speculative play, just like a tech startup, right? So I don't hate on projects, even though there are a lot of scams out there. I just try to filter through them, and I'm not going to put my money in those that I believe are scams. But I'm not going to only invest in Bitcoin as well, because there's so many other projects that have absolutely outperformed Bitcoin in the last year, 2 or 3. So that's another way I think to kind of think about it. But moving on, I wanted to talk about the stonk market because we've got some weird stuff happening. The markets just continue to make all-time highs, but the breadth is really bad. What does this mean, guys? What do you make of this chart? And with the S&P and the Nasdaq, as of right now, kind of ripping above trendline resistance and starting to go parabolic, what's happening? And what should people make of this?
Yeah, when you look at the index, when you look at the indices like the Nasdaq, for instance, that we're showing there, the Nasdaq 100 is made up, mostly of the largest tech stocks. You think, Microsoft, Nvidia, Tesla, Google, Apple, et cetera. And those companies continue to power higher. But when you look at overall the hundreds of companies or thousands of companies that trade on the Nasdaq stock exchange, there are actually a record number. Last week, there was a record number of new lows on the Nasdaq, or at least multi-year number of new lows. And so there's this bifurcation happening in the market where, it looks like the markets are healthy because of big tech driving the indices higher. But when you actually look underneath the surface, this has been a really brutal third quarter, especially during earnings season for a lot of stocks. And there's a significant amount of companies whose stocks are in massive drawdowns, as you see there. So, even former darlings like the PayPal and Snapchats of the world, Teladoc, et cetera, many of those are down, 50, 60% in just the last couple of months. So there's a feeling, I think, among a lot of investors that it's actually been a really tough time in the market, despite the fact that the indices are hitting new all-time highs. And so unless you own only a portfolio of like large cap tech, then you're probably feeling some amount of drawdown on at least some of your positions. So it's a very strange market out there currently.
And then I guess the question is, well, what happens when the big boys start to pull back? Does that just crash the markets?
Yeah, I think if we see a failure of the market leader stocks, then you could have the overall market under pretty broad pressure. And the question is, well, what would cause that to happen at this point? There's so much passive index buying in the big tech stocks. There's a lot of momentum fund chasing in at the tops of the indexes. But if you go back to periods like the dot-com bust and things like that, you'll see the pattern play out where eventually the market leaders falter, and that creates an overall market decline. And when that happens, you'll have some really interesting trading patterns and buying opportunities, especially among some of the smaller companies that are left for dead. But yeah, I think there's absolutely risk, especially with interest rate increases on the horizon next year. You've got some pretty significant risk with what happens if, the market leaders start to falter. So that's definitely something we're keeping an eye on.
Awesome. Nick, what do you make of this?
I mean, yeah, I think that Trev hit the nail on the head. It's kind of tough right now because it's a matter of, okay, are we safe here because big tech is such a large percentage of the index that people should just continue to invest and ignore it and ignore any risks out there, and because big tech will hold it up? Or is this something that we should really truly be concerned about and either start to hedge against or start to change portfolios in anticipation of something happening? Like I said before, it is feeling like a house of cards. There's only a few ways it's being held up, and at least that's what it's kind of feeling like. And then under the surface, we have a lot of blood. There are a lot of individual stocks that are seeing some very significant drawdowns. Nothing to balk at. Granted, we were seeing absurd valuations in certain areas in terms of individual stocks, and where we are still seeing some pretty high valuations in certain. Peloton's a great example. I mean, this was a stay-at-home play. Valuation, started to expand, and things got, Zoom even was one that the same kind of idea happened. It had run up and then had a pretty significant drawdown. So, this is happening all over the place right now. And so even though we are seeing some huge percentage drawdowns from the highs, the valuations were stretched in a lot of these names too. So, but, it's a matter of, I guess it's a matter of can big tech hold it up and for how long? And now I don't know if I'm convinced that the Fed is going to raise interest rates enough to where the market will really care. At this point, it just feels like the market doesn't care about anything. But we'll see. That is a significant risk that we need to watch out for. And if inflation continues, inflation pressures and just the effects that can have, kind of like on multiple different areas of the economy, that's something that we need to pay attention to as well. I mean, Amazon, I think their earnings were weak, and that was kind of like, okay, we kind of saw that potentially coming with inflation and supply chain issues and yada, yada, yada. It's like, when is that going to start to affect more of big tech? And that we're not quite sure.
Yeah, I think you mentioned something there that's worth mentioning, which is the margin pressure that we've seen. So third quarter, you finally started to see a lot of the cost input increases hitting corporate margins. And so when you look at the forecast for corporate profit growth next year, they're starting to wane a little bit. And even in big tech, like you said, Amazon, potentially Apple having some chip production issues. I mean, you could see even the big guys start to have corporate margin pressure. And that, I think, in combination with interest rate increases next year, could provide some overhead risk. When you look back at the dot-com bubble and bust, though, there were several rate increases before the peak. So one of the things that was happening alongside the massive speculation in 1999 and early 2000 was the Fed was raising rates, and then also, of course, you had massive speculation across lots of different stocks. And so there were several periods of corrections. And then the market kept powering higher despite the rate increases. So it is very possible that for a while, maybe months or quarters, even if the Fed is raising rates, we could have the market shaking it off and hitting new all times again next year. But the thing that concerns me even more than the rate increases in the short term is corporate margin pressure. So if earnings stop growing, I don't know how you support the valuation levels, even among some of the best businesses out there. So that's something that I'll be really focused on over the next couple of quarters is what do corporate profit margins look like, and what companies can pass through price increases and things like that. To me, that provides a pretty big source of risk that we'll have to keep a monitor on. But
And what do you guys make of like new IPOs like Rivian? That what was the initial IPO was like 100 billion or more, and they've released like 100 cars.
Yeah, the market loves concept stocks, EV stocks, particularly right now. There's sort of a tailwind behind companies that can promise a lot, but haven't actually had to produce much yet. And so the Rivian's kind of a poster child. And people got really excited. They're going to come out with the sexy EV truck, and there's going to be potentially EV subsidies coming out of these new fiscal stimulus bills. And, of course, what happened with Tesla's valuation over the past decade. And so people look at Tesla as potentially what could happen with a Rivian. And then you just have trader speculation in new IPOs, which are low float, fairly thinly traded to start with. And so I think even Rivian had a very high borrow costs for shorts last week, at least until towards the end of the week when more shares got unlocked. But that all creates this, trading dynamic where, it could almost go to any price, detached from fundamentals. And I think a lot of market observers are looking at Rivian and going, $100+ billion market cap for a company that hasn't proved they can produce at scale profitably yet. And that does have some echoes back to like the .com bubble. And, I don't really have a strong opinion on Rivian personally. I do think they're going to have a high bar to prove they're going to be worth 100 billion plus, more than Ford and GM's market cap right off the bat. Could they do it? I think yes, potentially, but it's going to take, many years for that to play out. So I'm just kind of sitting out and watching it, but it does feel a little bit like, more excess that we've seen that echoes what we saw in the .com days. So I don't know.
Lucid is another one that's
which
kind
one?
of nutty. Lucid, I mean, that's over 100 billion, I believe, market cap. It's like, but these vehicles are not cheap either. They're very pricey, and it's like thinking about how they're going to get mass market. And then there's so much competition now between Tesla, Lucid, Rivian. We got Fisker, we've got Polestar, right?
Yep.
Now all of these, and then all of the large legacy vehicle manufacturers, Ford, GM, Volkswagen, whatever, they're all going to come they all have EVs. A lot of them already have EVs if they're not working on them. And there's just going to be a lot of competition out there for these electric vehicle makers, I feel. And I don't know. I guess I'm not seeing it, but at this point, it's like I'm thinking about just creating a portfolio and putting a bunch of these EV stocks that are ridiculously priced in them, because everyone's who knows what these things are going to do. A lot of them probably are feeling like, oh, if Tesla can do it, Lucid can do it, and it could get very, very nutty. So I'm almost thinking like speculatively trading these things over the next, I don't know, year, 6 months to a year could be an interesting thing. Not investing in them, but speculatively trading them. There's a big difference.
Yeah, it's kind of like playing a game of hot potato, right? Like, if there's momentum and you can trade it on the way up, great. But you don't want to be the last one holding the bag when the DJ turns the music off.
No, because Tesla is like in a league of its own. It's more like a religion than anything, but yeah, like everybody is looking at that saying that, oh, this is what's going to happen with these stocks. And I think that's a dangerous mentality. Could it happen? Sure. But eventually, these stocks are going to have to prove to the market that they can financially perform for investors, right? Even Tesla is going to eventually, the market when they see that, margins are declining, and maybe they're not selling as many cars because the competition is increasing. Those types of things eventually may happen. And these stocks are just like Peloton, just like a lot of the other companies that their valuations went kind of nutty. They're going to see some potentially huge drawdowns if the market turns on them. And that can happen so fast, like you said, on a dime. So I don't know, but I think trading vehicles, sure. At this point, that's what these electric vehicle stocks are to me, not investments.
Yeah, we see the same thing in crypto, where a lot of Bitcoin competitors look at what Bitcoin's done over the past 10 years and they say, well, we can do that too. We can outperform. And 99.999% of them may have good bull cycles, right? You might be able to trade them and accumulate more Bitcoin or accumulate more fiat that you can reinvest. But over time, most projects are going to underperform Bitcoin for many reasons that we've talked about before, but it's kind of the same idea, right? They look at it like you'd look at a Tesla stock and say, oh, well, we can do that too. But Tesla has first mover advantage. They've got the cult following that, they've got Elon, blah, 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 blah. And it's just like all the copycats that have come and died after Bitcoin, and many of them will die. So that's why, we don't really hold a massive basket of hundreds or even dozens of cryptos that try to compete, especially Bitcoin copycats and things like that. So interesting to think about. Yeah. But I guess the next metric that we could talk about is housing, right? So when we look at different things like inflation and, what are the bellwethers for potential bear markets and things like that. Nick, I think you posted this, just taking a look at existing home sales, and we know the housing market has been on fire, but it looks like the housing market might be starting to slow down a little bit. I don't know. What do you want to cover here?
My view on this is that, month over month, we did see a decline in existing home sales. But if you actually look at the overall trend, which is the top chart, we saw existing home sales kind of decline a little bit, but it's starting to recover. So the housing market is still strong, in my opinion. We're still seeing some pretty impressive price increases in certain areas of the United States. I'm reading some suburbs in California are seeing 17%, increases in prices year over year, housing prices, and places in the Northeast are seeing double-digit price increases as people are trying to get to the mountains and get more space. And it's just the housing market is still on fire. And even though the data, was showing a decrease month over month, and the headlines were showing that, I think overall we're still seeing strength here, especially above average strength. And I really don't see that slowing down quite yet.
Yeah, let's take a look at some of the housing indices. It seems like one of those situations where, like the demand is still pretty strong, but the supply is still very, very far behind. So if we look at XHB, which is, the home builders ETF, you can see this thing's been over the past couple of weeks, just made a new all-time high. I don't really follow individual like home builder stocks that closely. I don't know if you guys do or have any insights there, but it just, it seems like there's still kind of that inverted supply demand where there's just not enough supply for the demand. All right. Next up, let's talk about COVID, everybody's favorite subject over the past couple of years. We've still got looming risks here. Austria just went into a crazy, really, really tight lockdown. Germany's numbers, at least new cases, are going parabolic. Deaths are quite low because they have a pretty high vaccination rate. I wish we didn't have to talk about this as still a risk for the markets. And again, we don't get political on the show. We just look at the data and try to figure out how it could affect our investments. What insights, if any, do you have from this latest pop in these lockdowns, or any opinions here?
It's interesting. So I think there's probably some effects from cold weather. Obviously, those are, for like northern countries, and we are seeing some uptick in cases even in the southern countries as well, but not as significant. And then seeing a rise in a few states in the north, in the U.S. as well, places like Michigan. So it does bring up the question, how much of this is cold weather driven, and is this just a temporary thing that we're, not going to need to worry about by February or March? But, in the near term, I think it's frustrating because it's like, are we ever going to get out of this thing? I don't see that clear of like trading implications from it currently, just because I think, especially looking at the situation now versus 2 years ago. 2 years ago was a massive surprise. We didn't really know how to treat it. Today, the treatment options are expanding. You've got more vaccinations, so the severity is down a lot. So I am less worried about it now as a driver of, trading opportunities in the market or risk in the market. But it is something that is relatively frustrating. I do think you could look at some of the stay-at-home stocks potentially as a way to, play the trend. They don't seem to be reacting to it yet. But I guess if this got to be a severe enough problem, we've seen like there's already lockdowns in Austria. Some of those stay-at-home stocks could come back into favor. They've been getting hit a lot in the past couple of months. So, stocks like Zoom or Peloton, things like that, maybe a way to play it. But again, I don't think this is the same setup that we had, in the second wave or certainly the first wave. So, hopefully this is just a kind of a shorter term issue that plays itself out through winter, and we don't have to lock a bunch of countries down again. But there is still a problem, and I don't know when that ends. So I hate that we're talking about it.
I know. I would hope by now this would be a thing of the past, but it's still a little, it's still a risk to the markets, still affecting people. And I tend to agree with your sentiment that people have moved on, at least from a risk perspective, and we're not going to see like a shock anytime we have a wave or cases increase. And, people are just ready to get back to work and get the economies rolling again.
Yeah, we've even seen like the protests in certain countries just this past week where people are pushing back against these lockdowns. And at some point, I kind of agree. We got to go live our lives again. If you are willing to take the risk and, you see that the caseloads are low, there is on the other side, obviously there's the whole argument of, well, what happens if we fill up our hospitals? And that becomes an issue because anyone that gets sick can't get treated. There's certainly concerns there, but yeah, I think people are just sick of it. I think that, people at this point, you're either vaccinated or you've made the decision not to. And it's kind of like, well, we'll take it as it comes, and we're just going to have to move forward.
Yep. Agreed. All right. So next up on the docket, we want to talk about pensions getting riskier. Nikki, what was your thoughts on this one?
Yeah, basically, so CalPERS is the largest pension fund in the U.S. It's California, the California Public Employees Retirement Fund. And basically, the main point here that I wanted to bring up that a lot of people I find don't actually know is, a lot of people depend on pensions. Either, they may work for schools or for the police department or whatever for the government. And what a lot of people don't realize is that pensions are investing in stocks, bonds, they're investing in private equity, they're investing in, riskier assets. It's not like the money's just there and you're going to guarantee your payment and you can count on your pension and nothing's going to happen to it. There's risk here. And that chart right there, what's happening is a lot of pension funds are actually decreasing their cash holdings and they're increasing their investments in private equity. They're decreasing their bond allocations because bonds are kind of trash right now. And, they're taking losses on bond positions and they're having to sell some positions in certain assets at losses. So pension funds are kind of really in a tough spot and they're having to take on a lot of risk right now. So I think that it's just important to make people aware that pensions are invested in risky assets too. And they have just, that is something that you have to consider, that there's a possibility that down the line, if something happens, you may not get the full pension payment you expected, or, sure, maybe there will be a payment, but it may be lower than you thought. And I just think it's an important point, because a lot of people just assume that pension money is a guaranteed thing and there's no risk to it.
So would you say that people might have like a false sense of security when it comes to their pensions and think that it's just guaranteed and maybe they don't understand how it works?
I think a lot of people see it as guaranteed money and they don't know how the money is actually invested on the back end, or they don't even know that the money is invested, period. I mean, so it's just, I think it's something good to educate yourself on. And when you're doing financial planning, you've got that pension. That's something you can put into your plan, of course. And odds are everything will be okay, but there are risks out there. And it's very clear that certain pensions are doing a lot worse off than others. And they're running into issues with, like I said, having to take losses, having to hold less cash, which is risky if you have a lot of payments. A lot of people are leaving the workforce and retiring and starting to take their pensions. That's an issue, because we've seen a lot of boomers actually leave the workforce and they're starting to take those pensions and go have fun in retirement. And that is strapping pensions who need people to come into the workforce and pay into that pension, right? So there are just a lot of the issues right now in the economy. It's just funny how things can trickle down. The labor shortage, the retirees, retiring earlier than expected. It's like all of this kind of, and then the market environment we're in, that affects how pensions are earning money to be able to pay. It's just, it all works together. And I think everything kind of affects everything right now.
Well said. Let's do some Q&A and then we'll go ahead and wrap it up with Thanksgiving being a little bit of a shorter week, talk about the charts one more time, and then we'll wrap it up. But a question we got from Sebastian, he says, "Hey guys, love the show, learned so much. I'd like to ask you guys about the quote, sell half on a double risk management strategy. I've heard conflicting opinions about it. What are your thoughts, and do you use it?" So basically the question is, when you buy something, some people say, hey, if you get a double, if you buy something at $1 and it hits $2, sell half of your position, take your risk capital out, or something along those lines. Do you guys follow that, or do you do something different, or what do you think about that strategy in general?
I don't know. I feel like it might be too blanketed. I feel like I mean, if it depends on what you're investing in, it depends on your plan. It depends on, what your profit targets are. And if you're going to hold for those targets long-term, very long-term, then you may be shorting yourself there. I think it depends, but it might be a bit too blanketed. I think trade management and investment management is more dynamic than that, or it requires more dynamic thinking and planning. I think that's just my opinion, but it's not a bad
some
thing
assets,
if you're just not sure what to do.
Right. Yeah. Some assets, it might be, you're way underselling yourself if you sell on a double. Others, it's like a double of Apple from today's valuation might be a little bit absurd in the short to medium term. Trav, what do you think?
Yeah, I mean, that strategy is cool because you get to take out your cost basis and leave some on the table. But I think, like you said, it's a case by case basis for me. If a stock is well beyond my fundamental target, then I think it's a great strategy to take cost basis fully out and have a runner or have some position left to be able to ride it. But there are some situations where the stock might still, have a triple left in it, and I'm waiting to take profits. The time frame matters too, long term versus short term capital gains. Because your tax rates on your gains can be very different. So, if it's month 11 and you've got one more month till you hit your long-term capital gains treatment, then it probably doesn't even, doesn't make as much sense to sell even on a double. So yeah, it's case by case specific, but I do overall like the general concept of being able to take cost basis, a significant portion of cost basis off the table when a stock has run up a lot, so that mentally you're able to let a lot of the remaining position ride without having to worry about it as much on a day-to-day basis. Psychologically, I think that helps a lot of people with not selling the rest of the position too quickly.
Yeah. Yeah. When it comes to taking risk capital out, it's always good to look for opportunities to do that. Right. But profit targets are dynamic. They're not always the same. And if you use that as a blanket, it seems like, sometimes you're going to way undersell yourself. Sometimes you're going to close way too soon, way too late. So I think it makes sense, like you guys said, to take everything into consideration, the asset, the targets, if there's fundamentals, if it's a stock, if it's crypto project, it's a little bit different on the fundamental side. But in general, I think it's smart to look for ways to manage risk, and that can be a really powerful one. But it maybe look for, a little bit more of a nuanced way by looking at what that specific play is. Cool. All right. Well, let's go ahead and take one more look at the charts, and I'll tell you guys what I'm thinking for this next week going into Thanksgiving. And I want to hear if you guys have any opinions or ideas, or dare I say predictions. Taking a look at Bitcoin, obviously we've been pulling back. I'm paying a lot of attention to kind of the mid 50K zone. Let me see if I can pull up my tweet here. I tweeted a few days ago, just kind of showing where I thought the highest probability pullback area was. And let me see if I can pull it up. Yeah. So this was, I think, last week. Where I said, hey guys, look, that based on the chart, the highest probability pullback area is in between 51 and 55K. So we'll see if buyers can give us a bounce inside of this zone. But you can see from the prior run, we've got the sweet spot Fibonacci retracement zone. We've got prior pivot high resistance turn support and the 100-period moving average. So that's what I'm watching. If Bitcoin gets significantly below the 50K zone, that's going to shift the current market structure into a bear market, and I will adjust all my positions accordingly. But if we get a bounce from this area, that's really what I'm looking for a new all-time high to convincingly break, is kind of like a massive cup and handle or inverted kind of reversal pattern around here to break the 70K zone. And if that happens, I think it's game on. We're going to get another quarter or two or more of bullishness. If not, we might need a pause, and we might even go into a bear market. So I think the point is this is a key inflection zone that I'm just keeping a lot of eyeballs zoomed in on. How about with stocks, guys? What are you guys thinking is going to play out over the next week or so going into the holiday season?
Well, we're seeing today, another day of really bad market breadth. The indices are up today, but there's a lot of stocks selling off significantly. You look at stocks like even former darlings like Square, or I'm just looking at a few here on the list that are down big. I mean, even Datadog, some of the former market darlings are down over 4 or 5% today. So we're in a really interesting environment that could get pretty volatile here. So typically the Thanksgiving week would be less volatile, and traders are going to go home after Tuesday. But I think we have potentially some fireworks that could happen in the market over the next month before year end. And then, of course, you're also going to have some tax selling in certain stocks that are already down. And so I really do think there's going to be some interesting buying opportunities. I mean, I think there already are interesting buying opportunities here. And I think we could see some pretty epic, maybe similar to like what we saw in December of 2018 types of opportunities in stocks that may be down 30, 40, 50% over the past few months that provide really, really interesting dip buy opportunities. So I'm very, very much excited about what I'm seeing in this sell-off. So we're seeing a lot of volatility, even though it doesn't look like it when you just look at the indexes. So that's my take.
Nice. Nick?
Yeah, I mean, I've been raising cash in my portfolio with a similar idea that looking for opportunities. A lot of stocks are down a lot, even though it doesn't look like it if you look at the S&P 500 or the Nasdaq, but they are. And as active investors, I know Trav is fully an active investor. I am a passive plus, I have an active portfolio. So I'm really, tuned in right now for potential opportunities in the active portfolio. And yeah, that's kind of been what I've been doing, is looking for those big panics.
I mean,
dumpster diving.
There's kind of a panic happening right as we speak today. Square's down 8%, CloudFront's down 8%, Rivian's down 13%. You've got Affirm down 10%, Airbnb's down 8%. I mean, these are big moves in stocks that a lot of people have been owning and very excited about and have performed well over the past year. And yet I'm looking at the indices, S&P up 0.7%. Even the Russell's up 0.8%. The Nasdaq 100's up about 0.2%. So this is very, very strange action that we're seeing. And it feels almost like a little bit of a mini flash crash in, the names that are not at the very, very top of the index. So
yeah. And then kind of on the flip side, you've got, I guess this is why the indices are up right now, is Apple's up, 2.5%.
Tesla's up 4%. Nvidia's up 3%, Those are the things driving it.
Microsoft.
Got a lot of bifurcation.
Yeah.
Interesting.
Yeah, I mean, Tesla looks like it's about to break out again. It's like crazy.
Thank you, Papa.
I guess we're going to see 2 trillion. I don't know. I guess we're going to see 2 trillion on Tesla. At this point, I don't think anybody can really make sense of it.
Yep. The markets can stay irrational longer than shorts can stay solvent. And then once all the shorts get squeezed, maybe that's where the top is. Awesome. All right, guys. Well, thanks for joining us. Thanks to YCharts for sponsoring the show. And for anybody that wants to invest alongside us or see how we invest and learn what we do, you can go to wetalkmoney.com/community, and that'll show you what we do in our wealth building community. We have a Discord channel. We do live classes. We have alerts and watch lists that we put out, and also some investing courses and live market updates. So if you guys want to check that out, just go to wetalkmoney.com/community. And also have a great Thanksgiving week for all you guys in the US. And yeah, we will see you guys next week. Thanks to Trav, aka Stock Geek TV. Go check out his YouTube channel and push him to do more content. And Nikki, she talks finance.
Yeah, thanks.
Awesome.
Thanks everybody
y'all.
for watching.